Good morning, everybody, and thanks for joining us at this morning's webinar. My name is Jonathan Sheehan.
And my name is Robert Smith. Hi, guys. Welcome back.
Thanks for joining us last week, for those who were available for the introductory webinar to financial planning. And today we're going to speak about cash flow planning. So it's the first of 6 modules. Based on the feedback actually from some of the polls we did last week, cash flow planning certainly seemed to be of the most interest to people. So hopefully you guys are all looking forward to this webinar this morning. From a housekeeping point of view, there is a questions button, a Q&A button, as you can see on Zoom. So you can put questions which are anonymous to Robert and myself. Well, it's anonymous to each other, but myself and Robert will see who asks the questions. I will endeavour to answer those questions throughout the webinar or at the end. This webinar is being recorded. We're being recorded. You're not being recorded, so that we can circulate to you afterwards if you want to watch back, or for any of your colleagues who are unable to make it today. We'll also send the slides after the webinar. And this registration that you have for this webinar series is the same for every week for each of the next 5 sessions. So all you need to do is log back in next Friday morning, and you get a reminder an hour and a full day before the webinar from Zoom. And all you have to do is click that and you're in again. So as I said, Jonathan Sheehan is my name, and I'm the Managing Director of Compass, and my colleague Robert Smith will be discussing some points. So we jump back and forth between the two of us, and we'll have a few polls to keep it interactive. We'll give a little 60-second exercise for you guys to do. And as I said, any questions, no matter how basic or complex, do put them to us through the Q&A tab. So last week we discussed an overview of financial planning, which the slides and the link for the video should have been made available to you, or can be made available to you. Today we're discussing cash flow planning. Next week we're on to pensions and retirement planning. So you're all members of the JLL occupational pension scheme. So we'll talk about that and just pensions and retirement planning generally. We'll then discuss protection, which often is the least interesting topic for a lot of people. People are the least interested in it, but arguably the most important, or one of the most important areas of financial planning. That'll be in 2 weeks' time. We'll then speak about tax and the tax rates in Ireland, and PAYE tax, and all the various taxes that us as individuals try to reduce as much as possible. We'll speak about investing and all asset classes, given the way markets are at the moment. That'll be very relevant, no doubt, and that's the 15th of July. And finally, we'll be speaking about mortgages and debt, and we'll be joined by our sister company in Cork, mymortgages.ie. And that'll be very, very interesting, I think, particularly for those who are about to get on the housing ladder, or have potentially just bought a house recently and are about to draw down a mortgage, or are looking to switch a mortgage. Okay, so let's roll up our sleeves. Cash flow planning. So the most important thing, the key takeaway from this session today, is that everybody, every one of you, should know what your cash flow position is. Okay, we're all busy. I get it. We're all busy in our day-to-day lives, family, work, all the usual stuff. But it's so important to make a big pot of coffee and lock yourself in a room and with your family or your spouse or your partner, whatever it is, and understand what your cash flow position is. So you need to calculate all of your current income and outgoings. Your current income and outgoings. You also need to look forward and say, how do we feel our cash flow position is going to change in 1 year or over 5 years? And you need to look at any one-off changes to your cash flow position. So are you buying a house? Are you buying a car? Are you selling something? There's so many factors there that you need to look at where you currently are and where you're going to be in 1 or 5 years' time. Obviously, through COVID and lockdowns, most people actually spent a lot less because we weren't allowed to travel, we weren't allowed to go overseas, we weren't allowed to do all these things. So looking back over the last 2 years is probably the wrong thing to do if you're trying to analyze your spending. it is actually a case of sitting down with your bank statements and a spreadsheet, which we'll share with you in due course and some tools, but you have to understand what your current cash flow planning position is. The 50-20-30 rule, now it's very hard to stick to this religiously, but just to give you a high level overview of how it might look, it's that of your net income, if the first 50% went on essentials. Now I know that's tough at the moment with the way inflation and energy bills and more potentially mortgage rates in due course, but if the first 50% went on essentials, or if, before you do anything else, the next 20% goes on saving and retirement funding for the future. And then the rump, or the last 30%, is where your discretionary spending comes in. Now, what you don't want to do is to start off with the discretionary spending and say, money comes into my bank account on whatever day of the month, and I'm going to spend it on all these things. And then you're scurrying to find money for the basics, the living costs, that type of thing. So it's just a nice rule of thumb. Everybody's situation is different, but it's just worth pointing out. It's a nice formula. If you can increase your income at a higher rate than your outgoings, you will have more cash flow and you'll have more ability for discretionary spending and long-term savings. That's the key to this. So the elasticity of cash flow planning. So if somebody says, well, my income went up by 10%, therefore my cash flow surplus is now up by 10%, or my outgoings have increased by 20%, my essential outgoings, so therefore my cash flow position has got worse by 20%. That's never actually the case. So just two examples here. So let's say your income increases, but your essential outgoings stay the same. So your net income, say on a monthly basis, went from 3,000 to 3,500 per month, for example, but your essential outgoings stay the same. Well, your surplus will actually go from 1,500 to 2,000, which is actually a 33% drop versus a 16% income increase, if that makes sense. Equally, a negative example is that if your essential outgoings increase, but your income stays the same, you might find that your essential outgoings go up by, say, a third, but you might actually see a 50% hit to your net surplus if your income stays the same. So always be mindful of looking at your essentials, your discretionary. We'll speak about that as well, and what your net income position is and how the elasticity of this works. Sometimes you feel as though you're struggling financially, but you may not be struggling by as much as you think you are. Okay, I'll give you examples. From a cash flow planning point of view, you might be cash flow neutral in that a family or a couple or an individual, basically at the start of the year, at the end of the year, you have the same amount of cash in your current account. But actually your capital position might be increasing if you're paying the principal element off your mortgage, for example. So someone says to me, we're paying 2,500 a month into our mortgage, that's 30 grand a year, that's killing us from a cash flow point of view. I'll say, okay, well, show me the statement or have a look at the statement from the bank. Well, actually, of that 30,000, 20,000 of that is principal repayment and only 10,000 is interest. So yes, it's a cash flow drag, 30,000 per annum, but of that, your 20,000 is coming off your principal. So all else being equal, your capital position on your property is increasing by 20,000 per annum. You could say the same for personal pension or AVC contributions to your pensions. If you say decided to max your personal contributions to a pension, you might feel the squeeze from a cash flow point of view, but the value of your pension, all else being equal, will be increasing. So that's another way of increasing your capital position. So your wealth is actually increasing even if your cash flow is slightly negative. And lastly, if you were putting money into a savings account or an investment account, that will have a drag from a cash flow point of view, but actually you're appreciating your capital position. So there's nothing wrong with being cash flow neutral as long as some of your outgoings are increasing your capital position. I'll hand over to Robert Smith now, who'll speak about income and outgoings.
Thanks, Jonathan. Yes, that's very relevant. And as Jonathan alluded to earlier, it really is important that this be the first module, because as we saw in the introduction, all other modules, all other aspects of financial planning actually just flow from this today, the core, which is cash flow planning, understanding your income and your outgoings. So firstly, we will have a look at a rainy day fund. What is it? As you can see, the simple answer is, do we need one? Yes, we do. We definitely do. There will be different names for this fund. Some people will call it perhaps an emergency fund, or even an opportunity fund. To a lesser extent, people would view it as an opportunity fund, but it can actually be both. The amount you actually set aside for a rainy day, as Jonathan said earlier, it really depends. For some people, that's 6 months income. For some, it's 12. If you're in a fortunate position to have more, of course, that's even better. And we'll definitely give you some examples here of what a rainy day fund is, as we will allude to now. So it is a security of your income. So it's very important how you look at your rainy day fund and who actually needs one and why. So depends on your stage of life, but at all stages, you should have one. In some stages, it's far more relevant than others. So if you're a public servant, for example, like a teacher, let's say on a contract of indefinite duration, you would have perhaps a lesser need for a rainy day fund of a certain size. But if you are, for example, a startup employee, and if you're outside of the civil servant sphere and you're in the private sector, you actually will have far more much need for a rainy day income because you have less job security. So it's very important to factor that into your planning. It's also about your risk appetite. So risk averse people will generally sleep easier. They will indeed, knowing that they have the money set aside. So having that rainy day fund will mean that you have that freedom, that breathing space. And it means that you can also plan ahead further. As we will discuss as we go on, you'll see in the cash flow planning elements that there are many advantages to actually understanding your current cash flow, and a rainy day fund makes up a huge part of that. It's essential to be able to factor in those unknown costs. Financial independence, of course, and your financial dependents, your children, they would be definitely dependent upon having those funds. As you know, there's a lot of surprise costs that come up. Children have a lot of costs also that have to be factored in. We're during the summer period at the moment, and in terms of camps and in terms of other trips and things that they may do throughout the year, there's often costs that creep up, the replacement of clothing and so on. So always having that fund set aside for your children. If you have children, you will know that that's actually a very wise thing to do. And lastly, uncertain costs. They strike all of us. It could be something like a major car repair that just crops up, or it could be something like, let's say, a medical cost that you weren't factoring in. Those two events happened to me in the last 6 or 7 weeks, and both were very, very expensive. Both were completely out of the blue, and having a rainy day fund set aside meant that I was able to absorb that hit and then move forward. And it's those type of surprise costs that we have to be very conscious of throughout the year. They can just creep up out of nowhere and they can catch you off guard. So the forms of income. What forms of income are there? There's essentially 2 forms of income. The first one is earned income. For most of us, that will be just one source of income. The vast majority of people in Ireland have one source of income, and that's through our employment. So if you're like yourselves there at JLL, you'd be PAYE tax deducted at source, you're PAYE employees. That is your main source of income. For some people, they would have other sources of income, however, so that would fall under the other type of income, which is known as passive income. And we did touch on this in the overview, and many of you would be familiar with that term. So passive income, what is it? What does it look like? One form would be pension income. A pension income that you derive from your pension on an ongoing basis. That can be an ARF payment from an approved retirement fund, or it can be an annuity payment that you're in receipt of in the future, obviously, if you're not retired at the moment. The second is investment income. That could take the form of dividends, let's say from stocks or shares you hold. The third is rental income. For some of us here today, we are in a position where we actually have a second property. We might have a room rented out. We might have a room in the back of our home, perhaps, or a granny flat, etc., rented out on our property. And that's another form of income that is passive. It's something you don't have to physically be present to earn. So that's what passive income is essentially. You don't have to physically be present in order to earn it. It's being paid to you. And lastly, then the state pension, of course, is another form of passive income. It's currently around the 13,000 per annum mark, and you'll be in receipt of that from age 66 in the present term here in 2022. that is another form of passive income. It's something that a lot of people don't factor in, but obviously they greatly anticipate receiving those funds. We don't know what they will be at the point of retirement. This is what it is presently, but that is a passive income to factor into your financial planning. And we will see that in our cash flow projections later on today. We're going to have a quick poll at the moment in relation to earned or passive income, just to see who's paying attention. You should see a poll popping up on your screen any moment now. Just be careful with the question itself. Have a quick read of that. It's worded in a particular way. It might catch some people offside. We had your colleagues this morning give us quite interesting answers to that in the first session today. So I'm just very curious to see how the voting will take place. I'll let you know how they voted in a moment. Take a moment there to have a think about it, and we'll discuss the results in a second. So is it employment income, investment income, or pension income? I won't give you any clue in the question, but I think we should score quite well today. It's 11 o'clock, so we'll make allowances for the your colleagues at 10. I see the results coming in there. Overwhelmingly, as you can see there on your screens, employment income, 80% of people said employment income. Which of the following sources of income are not passive? So there's the not part that would have caught a few people out this morning. I'll tell you the results of your colleagues. So 80% of yourselves correctly answered employment income is not passive income. Investment income, we had 10%. Investment income actually is passive income. Your colleagues this morning, there was 30% said that that is not passive, when it actually is passive. So you've scored very well. And pension income, of course, is also passive income. So that is where we are in terms of earned and passive income. Thanks for taking that poll for us. And we'll move on to now to calculating your income and outgoings. How do we do that? What does that look like? Where do you sit in terms of your own personal category at the moment? So we would tot up our gross income. Doing that is very easy because most people will only have one source of income, which is our employment income, obviously. If you're fortunate enough to have 2 or 3 sources, it's still only 2 or 3 sources of income. It's very easy. Everyone knows what they currently earn because it's only coming from 1, 2, or 3 channels, some instances 4, but it's always something that's within your grasp because there's only 1 or 2 streams of income coming towards you. It's a lot harder to calculate your outgoings, as some of you will discover and have discovered and are about to discover very shortly. So what does that look like? Well, if your gross income is higher than your tax plus your mortgage or rent and all outgoings, then you have an annual cash flow surplus. That's where everyone wants to be. That's where everyone wants to find themselves. You may have noticed that your cash flow surplus has shrinked recently due to inflation, but that's where we all want to be. In terms of your gross income, if it's less than all of those outgoings, then you have what's called a cash flow deficit. You don't want to be in that position. And knowing those incomings and outgoings is how you actually position or reposition yourself to find yourself in a surplus or a larger surplus than normal. I'll pass you back to Jonathan. Thanks, guys.
Thank you very much, Robert, and thanks for participating in that poll. And keep those little questions coming in. The more interaction we get, the better. So now when we look at outgoings, firstly, there's a really good tax calculator that I would suggest you use. Here's the link. It's from Deloitte, who are your neighbors there in Hatch Street. But I find it very, very simple because if you put in your details and your income and your marital status and the various other questions, the net income figure from this page would be exactly equivalent to what your net pay is at the moment through your payroll. But it's useful for predicting income into the future to say, well, what if my salary was X? What would my net income be? Because it is very, very difficult, or a lot of people find it difficult to understand how the tax system works in Ireland. And we will have a full tax module later on. But because we've got 40% income tax, 8% USC and 4% PRSI, and each of them have different bands, it's very difficult sometimes to understand, well, if my salary was X, what would be, because all people care about is what would be the end net monthly amount that I'd receive into my account. And Ireland has a progressive tax system, which means that as your income increases, your tax rate also increases. So somebody on a salary who's, say, single, 35,000 per annum would probably only have a tax rate of 16 or 17%, whereas somebody on a salary of 300,000 per annum would have a tax rate of up to 52%. So it's just a useful tool I thought I'd share with you. Obviously, these slides will be sent out to you, so you'll be able to click on the link on the PDF. So what you have to do is you have to categorize your outgoings. As Robert says, the income part is easy. Most people have a pay slip coming in, and that's their income. And two incomes if it's a couple both working, and any other source of passive income. You need to look at your outgoings. Firstly, are they essential? So essential outgoings are things like your mortgage, your rent, your utility bills, food on the table, clothes for the kids, all that type of stuff. The next one is the discretionary spending. So Lee and myself and Robert and Catherine in the office were talking about this last week. And we were saying, we'll give examples of discretionary. And even within the office, the four of us were having debates as to, well, is the gym or a bike you want to buy for your treks on a Saturday morning, or gym membership, or getting your hair done, is that actually discretionary? Because sometimes people actually feel as though that's really, really important for your psyche or for life generally. So we created a third column, or third category, non-essential discretionaries. So if each of you actually looked at all of your spending, and the best way to do it is literally go to your bank statements, your Revolut or whatever it is, and look at where am I spending the money. So is the 2 nights down in Kerry at a wedding in a 5-star hotel, and all that, the 1,200 euros you spent on that, is that really essential? No. Is it discretionary? Well, maybe not, because if they're relatives or friends of yours, you have to go to the wedding. So you might put that in the category of non-essential discretionary, whatever it might be. So what's essential for one person or one family may not be essential for somebody else, and vice versa. So you need to understand what is essential discretionary and non-essential discretionary for you and your family. So before we move on, would you mind just spending the next 60 seconds, hopefully you all have a pen and paper in front of you, and just have a think about, well, what are the living costs, and what is that thing in my head that I wish I spent less on, or where is my money going? And just think about the living costs and how you'd categorize them for a minute, and then we'll do a quick poll and continue the conversation afterwards. Okay, thanks for that. So now we're going to have another quick poll to say which of these expenses would you categorize as discretionary. It's kind of a bit of a, there's no right or wrong answer. You only can give one response, but there's probably more than one answer, correct answer, if that makes sense. So yeah, I see some of the answers coming in. That's great. All correct so far. Okay, thanks for this. So let's spend another few seconds. Okay, thank you for that, everybody. So yes, these answers are very, very correct. Nobody said utility bills and nobody said mortgage repayments. That's definitely correct because they're essential outgoings. 60% said a 2-week overseas holiday. Correct. That is discretionary. You don't have to go abroad. You don't have to go for 2 weeks, all that. Restaurants, yeah, discretionary. I suppose it depends how much. It depends what type of restaurant. Debt repayments, one person, that actually can be correct because you may have taken out a loan for a discretionary purchase. So then it becomes a debt that you have to repay. So the very fact that you've taken out a debt might be discretionary. So that's not a wrong answer either. So, but overall, hopefully that poll was just useful to get you thinking and to understand, I suppose, what is essential and what's discretionary. Okay, so Robert now is going to speak about the top 10 culprits for outgoings.
Thanks, Jonathan. I think you already have a very good handle on discretionary and essential spending based on the polls. So that's a very good lead into this subject here. And it's very important to just have an understanding. What are those culprits? What do they look like? What are the outgoings that are actually pulling on me the most? A lot of us would have a relatively clear idea on what that is, but it's actually being able to categorize them, write them down, visualize them, and then actually implement a plan in place to make changes in terms of your outgoings. So that's something we're going to discuss in the coming slides in terms of a spreadsheet, an expenses spreadsheet, apologies, to do so. And we are going to circulate that to your HR department. You will have that spreadsheet that you can use and interact with and make your own essentially. So in terms of the culprits, obviously income tax is a very large and undeniable culprit. It's one that's unavoidable, unfortunately. It has to be paid and it supports the rest of our economy and society. So it's very essential, but it is a large tax. It's sizable and it's taken at source. So it's taken before you have a choice in the matter. In terms of your mortgage and rental repayments, that's often the biggest cost for the vast majority of people. What is your mortgage and rental repayments? They're on the rise if you're renting in terms of mortgages. If you're not in a fixed mortgage at the moment, from July onwards, it's projected with ECB interest rate increases that you'll actually be paying more in your variable or tracker rate mortgage. So that's something to consider, something to factor in when you're actually doing your cash flow planning. Very large cost for most people. In terms of the next costs, obviously house running costs and groceries. This is very topical at the moment, as you can imagine, because we have electricity costs, we've gas, we've heating, we've also got phone bills, internet bills, we've so many other aspects of our lives, so many fixed overheads, which go into the running of the home, and groceries, of course. You'll see that interest in terms of inflation, apologies, it's somewhere in the 8.2, 8.5% region this year to date. But actually, it's much higher. If you go into a grocery store, you'll often see something in the region of 20 to 30% or higher where you normally shop for your groceries. So that's definitely being felt by people across the board. Actually, on that topic, the ESRI released a report this week saying that 29% of people surveyed were feeling energy poverty. And that was a very interesting statistic, because the previous record on high historically has been 23%. So we've reached a new high of people feeling energy poverty. What is that? That's your gas, your electricity, your heating bills being more than 10% of your net take-home income. So those surveyed said they are actually having to really pull back on their electricity, gas, and heating use. Sometimes at times throughout the year, especially earlier in the year when they needed those, they were actually finding that they had to spare it out. So energy poverty is on the rise, and I hope there's a pullback. In terms of creche and school fees for children, obviously, that's very relevant. Staffing, again, back into those energy costs. One always feeds the other. So you'll see your creche fees are mostly rising. School fees for children, if you're in private schooling as well, you'll see that they are on the rise. In terms of your transport costs, there's a mixed news. It's good and bad. So if you're actually traveling yourself, if you're driving, you will see that your fuel has risen exponentially. And that's a factor in terms of the hybrid working. It can be very good if you're in that environment. But in terms of public transport, the government's actually gone to great lengths to help people. And you'll see that actually, depending on your mode of transport, whether it be the DART or the bus or whatever it is, or coaches, that the prices have actually gone down or stayed the same, which is very refreshing. I get the bus myself to work, so I can see that actually it's very reasonable in terms of traveling at the moment if you are taking public transport. So that's one upside to the current increased prices that we're all experiencing. In terms of holidays, the above factors have to be factored in. So your transport, how to get there, the actual cost of renting that property. You can see point number 2, renting the actual holiday home, let's say, for example, and then your groceries. Wherever you go, you will see your groceries by and large are much higher. Your living expenses for that week and the activities you participate in. So holidays are a big culprit in terms of your outgoings. Weddings, I think Jonathan touched on this earlier, especially overseas weddings, that's taking it to another level. You're going to have the above factors pulling on the costs related to weddings. Dinners and nights out is, if you've noticed, if you've been having a few of those yourself recently this year, you'll have seen that the costs of all have risen again. It could be 20, 30, 40%, huge increase across the board in socializing and enjoying yourself. And gifts to children and to grandchildren. We did mention last week that there's a €3,000 gift tax per annum, but you'll often see gifting to children and grandchildren as a big cost. And you're probably asking yourselves, depending on your stage of life, what is the gift? How much should I give? How much should I not? Because my gift last year will look far smaller than my gift this year if I don't increase that. So there's pressures there within the home, and obviously anything not mentioned above. So everyone has their own individual costs. They have their own individual outgoing culprits, and each person will know their own. And that's where the cash flow planning and just examining your spending costs really adds a lot of value down the line, as we're going to touch on in the following slides. So here is an outgoing analysis sample, and you will see that we've broken this down across a spreadsheet into various sections. We have our outgoings listed, some of the ones I touched on earlier and some new ones as well. We've exaggerated the figures here in order to provide a really rich data in the following slide, but in terms of categories, you can see essentials and discretionary is broken down. We will forward this onto your HR so you can have a copy of this and make up your own spreadsheet, which would be incredibly useful. And you can just break them down into what is essential, what is discretionary. If you see the word discretionary pop up far more than essentials, you'll see that actually, am I enjoying myself perhaps a little bit too much? That's something that you'll have to discuss around the kitchen table and decide for yourselves. What's your leisure like, your groceries? Again, you'll just get that rich data and you'll be able to see where is my money going? What am I spending it on? What's the frequency of those payments? Is there a better deal elsewhere? Should I cut back? So many questions can stream off the back of seeing data like this. So we'll just show you the next slide, how it pulls through in terms of your own life on paper financially. This is how it would look. Very, very useful. Just have a look at that, take it in for a moment. So we touched upon various aspects. For a lot of people, you'll see that your home, your groceries, your phone, your internet, your tech, perhaps your mortgage, it's going to take up the majority for most people. But then you'll see, how do I spend time? What's my leisure like? How do I spend my percentage of my finances on leisure? How much do I spend on health, perhaps education, clothing, cars, miscellaneous? Is miscellaneous a large aspect? As you can see there, it's 13%, but is miscellaneous taking up a huge sliver of my finances, my incomings and outgoings? And do I need to reassess, recalibrate that? And then you can see obviously a breakdown of what is essential, what is discretionary over on your right-hand side in the pie chart, just to give you an idea of that. So I'll pass back to Jonathan now to discuss some budgeting with you.
Thanks, Robert. So at this stage, you should be very familiar with what's essential, what's discretionary, and what's non-essential discretionary, and also what your income is. So if you have sat down and understood your current cash flow position, then it's all about, okay, what can we do looking forward, and how can our financial position be optimized when we look into the future? So one thing which a lot of people forget about is that if you strip out the capital element of your cash flow, your position may not be as bad. I know I alluded to this earlier, but you could have a couple with a high combined gross income, but they're saying, God, I don't have a cash flow positive position because all the money seems to come in and it goes straight back out. They should firstly do the 50-20-30 rule. But in this case, what actually happens sometimes is that if people take advice from the likes of us and say, you should be maximizing your ABCs into your pension. So husband and wife both working, maximizing their pension contributions. And if they also decide, well, I have a mortgage and it's over 25 years and the mortgage is, 500,000 paid down over 25 years. Ultimately, every single year, you're taking a significant chunk off the capital of that mortgage. So while you might be cash flow neutral, remember, you might actually be increasing your capital position at the same time. Another very important factor, no matter how young you are or how old you are on this call, is understand the time period of income or outgoings. There's nothing is forever and everything changes, okay? So every income and every outgoing, with the exception of what they call a whole of life annuity, which is you go to an insurance company and buy an income and it pays you for life until your last days. With the exception of things like that, incomes and outgoings will only last for a finite period. So the obvious one is that if you're on this call, you work for JLL, so you're an employee of JLL, and at some stage, unless you're going to work until you're 90 or 95, which is unlikely, your employment will cease on retirement whenever you decide to retire. That could be 65, 70, 60, whatever it might be, but your earned income will cease at some stage, okay? as well as that, your pension income will actually start at a certain stage. So you most likely don't have any pension income if you're working, but at some stage you will get the state pension at 66. By the time most people here are at 66, it won't be available, I'd suggest, until 68. But either way, when you retire your JLL pension or any other pensions, pension income will start at a certain age. Mortgage repayments will generally cease. It might be in your 60s, could be late 50s, could be early 70s. But a mortgage is a finite product, and outgoings will stop at some stage. So that's very important as well. If you've got children and they're currently in childcare or schools or whatever it is, at some stage, hopefully they will become financially independent, and they won't be as much of a cost for you going forward, because they might have moved out or they moved away or whatever it is, and they'll have their own income. So in my experience, having dealt with private clients and financial planning for 15 years, is a lot of people get to kind of mid, late 50s, early 60s, and they look at their finance and they say, wow, I didn't realize actually my position is quite strong, because we've been aggressively paying off the mortgage and now that's nearly paid off. Our kids have fled the nest, so they've moved out. So we're actually able to, that cost, education cost and just feeding the kids and clothing, all that, that's now gone. And our pensions are quite large because we've been putting in AVCs every year. So just remember the time period of all your incomes and liabilities. And as well, there's lots more examples which should be specific to your own financial position. Now, you may be in a cash flow surplus. That's where you want to get to. So if you have a cash flow surplus, well, what should you do? So there's a few options. As Robert says, you should always have a nest egg. Now, a nest egg could be 6 months of your net pay or 12 months of your net pay. In the likes of JLL, you have things like income protection. So you do actually have a lot of the risks mitigated when you work for a big firm, and you have life insurance and income protection, that type of thing. But the amount of your nest egg should be decided and then stuck to on a non-negotiable basis. That should be the first thing. You could then accelerate your mortgage repayments, depends on your interest rate, if you had a mortgage. I would always say, if you have surplus and you have your nest egg sorted, you should look at AVCs, so maximize your AVCs. We'll talk all about that next week. And also, okay, you have a rainy day fund, but you might also say, okay, but we have always said we want to get the kitchen done in the house, and that's going to cost X, and we want to get a new car, or whatever it might be. So it could also be worth setting money aside for a future capital outlay that's not necessarily a rainy day fund. Okay, so I'm going to do another quick poll here on cash flow surplus. So just 3 options here. If you have a cash flow surplus, which outgoing should you pay off first? So with a cash flow surplus, which outgoing should you pay off first? Okay, thanks for those answers, guys. So I'll just share the results now. Okay, so mixed answers. Now, what I would say is that the answer here should be a personal loan, because if you have a personal loan, by definition, that's not secured on any asset. So therefore, it's higher risk for the lender, which means that the rate of interest is going to be higher. So on a non-secured loan, like a personal loan, the rate of interest would be the highest. However, on a secured loan, like a mortgage secured on your property, the rate of interest is definitely going to be more competitive and lower than a personal loan. So I would say a mortgage would be the last thing you pay off. I'd say personal loan first, followed by a car loan, followed by a mortgage. Now, it depends on whether the different types of car loans and all that, but that would be a general rule of thumb. You pay off the most expensive debt first and the least expensive debt last. So other considerations, don't sweat the small stuff. So one of the advantages of planning is that you can get to see the big picture, and you'll be a little bit less worried if you do get the the latte on a Friday morning coming into the office and a croissant or whatever it might be. I mean, some of that small stuff in the grand scheme of things, unless you're doing it every single day, it doesn't really matter. One holiday a year isn't a big deal, whatever it is. So don't worry about some of the smaller stuff. Think big picture. You can save a huge amount of tax by just maxing your AVCs. For example, always try to think outside the box like that. Some living costs are fixed, so be aware of that. That it's out of your control what your energy costs are. I know you can be a bit nifty and reduce costs a bit, but a lot of the fixed essential costs are actually fixed by nature, so there's not much you can do about that. We have to factor in inflation, because inflation, as Robert says, is running at about 8.5% over the last 12 months. And we have to anticipate that, all else being equal, our cost of living, the goods and services that we consume, are going to be increasing from here on a continued basis. So if you're doing your cash flow planning exercise, which I mentioned earlier, you need to factor in an additional cost to running your lives, basically. So sometimes, unfortunately, you will have to pull in the reins on spending and live within your budget. And it's a difficult thing to say, but it is actually the case that you do have to, sometimes say, I can't do anything with the essentials, but I have to cut my discretionary spending. But equally, sometimes, and generally it's as you get a bit older and your financial position increases, you might actually have a bit more income at your disposal than you had anticipated. And that's what will come out of this type of budget exercise. So you might say, God, we can afford to spend more than we're currently spending. So I'll just pass back to Robert for the final couple of slides just on the benefits of cash flow planning.
Thanks, Jonathan. Yeah, it's I think at this stage you're probably coming up to being experts in terms of income and outgoings. Keep your questions coming in. We have a few minutes left, so if you want to add any more questions towards the end here, this is definitely a great time to do so. And also, we're just going to touch here on the benefits of cash flow planning, just to summarize up as well. What are they? What do they look like? So one of those, firstly, is to avoid annual deficit. It really does. Once you understand your cash flow.
So I think Robert's screen froze there, but I'll continue here with this. So one of the advantages is the cash flow is to avoid an annual deficit. The next one is ultimately to build wealth over the long term. To review unnecessary spending, that's exactly what the discretionary versus essential versus non-essential discretionary exercise will do, to avoid the spending that is not core, that is not actually necessary. And you could see huge savings by just making a couple of small adjustments. As I said earlier, reduce expensive debt. So if you have any bit of a cash flow surplus in your personal loans or loans that are high interest, to reduce that. And also to improve your capital position. So don't be afraid if you're running a cash flow neutral or even deficit position if your capital is improving over the long term. Just a few tools. This is our last slide. Always use a spreadsheet, because a spreadsheet can be referred back to, and we'll give you a good template of a spreadsheet and with all the lovely charts and that type of thing. And it is a great tool for understanding exactly how your finances will look into the future as well. So spreadsheets are good rather than pen and paper. I would say simplify everything. So sometimes people say, oh God, I sat down to do my cash flow and I have money in a credit union. I have money in a current account before I got married. And then we have a joint account and she has an account over here. And I think I have a few bob in that KBC account, but I have to move that because they're leaving the country. Before you know it, you've got 5 or 6 accounts, and that is a barrier to rolling up your sleeves and getting your work done, because it just creates complexity and you don't have your online access and all that. Especially with Ulster Bank and KBC leaving now, it's no harm just cleaning up your bank accounts and consolidating and centralizing everything, just making it simpler to refer back to. You should all have online access to your pensions accounts in JLL. You should have online access to any savings or investments accounts. Things like Revolut are very useful because you can put up the lovely charts and categorize all your spending. As I said earlier, that online tax calculator that Deloitte have for free on their website is very useful. And other apps, there's so many of them out there. These two, Monofy and Spendy, are really, really good. But again, it totally depends on your own situation. A lot of them are kind of Americanized, but you need to have the right tools in place. If you can't measure it, you can't manage it. Whatever tools work best for you, it might be sitting down on a Monday night, turn the TV off, take the laptop out and go through everything. Or it could be a case of, doing it at different times or doing it on your own or whatever it might be. So guys, thank you very much for your time this morning. We have one question that's come in here, which I probably only have time for this one question, if that's okay. It's asking about inflation and where we see inflation going over the next 12 months. It's difficult to know because a lot of what's happening with inflation is as a result of what's happening in Russia and Ukraine and energy prices. The rate of inflation on energy alone is about 26% at the moment. So that's one of the reasons why we're at the 8.5% inflation rate, because what energy constitutes has dragged up the average up towards double digits. If the Russia-Ukraine situation did somewhat dissipate, you could see a bit of a cooling off. Interest rates are increasing. As we know, they've started the process very aggressively in the US. The UK has followed, and we're going to be starting an aggressive policy stance in the ECB now as well, which means that the rate of borrowing for us in Ireland, the cost is going to be going up because they're trying to now discourage people from borrowing, because that's leading to speculating, which is heating the economy. So what they're trying to do is they're trying to dampen it down to say we're increasing base interest rates, increasing mortgage rates, our loan rates. So to cool the economy off, that could tip us into recession. But what it could also do is it could mean that people will stop investing in and speculating and buying things because of interest rates. As well as interest rates go up, deposit rates will go up. So people say, well, actually, I just leave my money in the bank and get 2% interest rather than spending it. And that could naturally bring down. David McWilliams, the economist, has a great expression. The solution to higher prices is higher prices. So when things, if you go to B&Q tomorrow and you're looking at things, you think, you know what, I'm going to put off the garden work project for another 12 months because, this would have cost us 2,000 last year. Now it's going to cost us 4,000. So I won't buy all the stuff in B&Q for that. And that naturally will create a potentially disinflationary environment. And that would be one solution to inflation. So everybody at JLL, thank you very much for your time again this morning. Do come back next Friday at 11. We've got the pensions webinar. Your registration details, you're already registered for it. You'll get an email from Zoom a day before and an hour before. Thank you for attending this morning, and we'll talk to you soon.